Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have our normal 5 segments. Thankfully, versus last week, it'll be a little bit shorter just because there's not as much data. We covered a lot last week. We'll let you digest last week instead of throwing out all this new stuff. So one of the things that we want to look at, and we're going to break it into our 5 segments. So in segment 1, we want to talk about a commodity price shock. And again, broadly speaking, commodities, not just oil and gas, or energy in general, but everything, looking at it. And how does that really lead to a recession? Short answer is, to the question on the title, is the answer is yes. But how? Why? And that's what we want to look at. And what is the kind of the continuing impacts because of that. Then in the second segment, we're going to look at how the Fed is shifting rates and how inflation is currently hitting consumers and how we think that's going to progress. In the next segment, then in the following segment, we're going to do the housing market. It hasn't started to slow. Are we starting to finally see some of these cracks? And then in Europe, sales are getting hit hard. We want to look at, how is the consumer looking? What is that going to do to European growth, which short answer is it's negative. And then we want to look at China credit impulses because they're starting to roll over. We've had some new information and new data come out that there's more problems afoot in the on the property side. So again, a lot of things to talk about. Luckily, there's only 87 slides, so I know that everybody's happy about that, including myself and the and our producer. So some of those fun things as we try to put all these pieces together. So without further ado, we want to talk about what has happened on the Ukraine war front. It's something that is going to be on everybody's mind, as it should be, just given the many impacts that it has to the world at large. So when we look at what has happened here, this is the assessed control of terrain. This is as of yesterday, mid-afternoon. There has been very little change. You can see here that there have been Ukrainian protests, which are the blue dots. And there's also been a counter offensive that has taken place. So when you look at where some of the counterattacks that have come from the Ukrainians, it is mixed in two areas. It is in the north, and if you're looking at Kyiv, it's to the northwest. You're starting to see some pretty aggressive attacks from the Ukrainians, and they're using both either small arms fire as well as some decent mortar attacks. And a lot of the pause has been Russians kind of trying to cycle in new people, bringing in some fresh blood. So we do expect to see another push and advancement, but also giving some time to the Ukrainians to prepare. So when you start looking at some of the different shifts in general, this is what we've seen. Now, President Biden is visiting Europe. We will have new sanctions coming out against new people within Russia. Now, when we start looking at the last several days, as we've been saying, there hasn't been a whole lot of shift. There's been kind of a stalemate at this point, and the Ukrainians have been kind of chipping away at some of the different pieces. So the Ukrainian armed forces have managed to advance against Russia forces in the northwest of Kyiv, along with intense artillery bombardment. Then there's some unsubstantiated claims that there are some Russian forces that are encircled by Ukrainians. So far, I can't confirm it. It seems like there's a likelihood that they have them capped on at least 3 sides, forcing a bit of a retreat. But it doesn't look like they're underlying stuck, and that's west of Bordanka, which is, I think, just an important piece because if you remember, as we've been saying, the Ukrainians have to keep the West open because that's where obviously the supplies is coming from the NATO nations. Russia has not been able to force any advances in the recent days. Several observations indicate that Russia is bringing again those new forces. Deployments have been observed at fronts facing both Kyiv, Kharkiv, and the Donetsk line. The Donetsk line is where we believe there's going to be a bigger push because they will want to solidify Mariupol. And so far, the Ukrainians have put up a hell of a fight in Odessa, and they've been unable to lock that down. But again, we do believe that the main goal is to lock out the coast in general. So lock out the coast and then kind of collapse in and then start heading north to go from Odessa, go north into Kyiv and try to block out that huge piece. But again, things to look at, things to watch. It doesn't mean that the Ukrainians are going to go down without a fight, and we continue to send in additional equipment, and by we, I mean NATO, and you're seeing a lot of those movements. Again, it's just, there have been wars in the past where the underdog wins. When you look at how Ukraine is fighting, that they're doing it right. If you want to say of ways to use their strengths, but again, when you're looking at Russia, they do have an overwhelming force, which becomes the bigger issue, which is why Ukrainians are focusing on going after the high-ranking officials, trying to go back and do counterattacks and ambushes on the back end of the line, disrupting those supply chains. USD ruble fell another 5.6% on the day. Again, biggest drop since 2014. We're continuing to see more pressure on the ruble. And obviously the CDS spreads have blown out as there's an increasing view that Russia will default. So now when we start looking at how the spending is shifting, and again, whether or not you like President Trump, because it's very easy not to like him given the way he speaks, this kind of harkens back to what he was saying with NATO, where when you look at how spending has been, you can see that the NATO guidelines say that 2% of GDP has to be spent on defense. And here you're seeing that many of these countries have been well below that NATO line. And this is now kind of a wake-up call of we need to invest. There needs to be investment, and the U.S. isn't going to carry a lot of that brunt, which is where we're starting to see some of these increases. How quickly will Europe bolster its defenses? A rise of 2% of GDP through 2030 is kind of where we're seeing. So we will see a big increase in defense spending. It will be from the Europe. The U.S. has made up a lot of these shortfalls in the European theater, but it's just going to be a benefit for the U.S. at least to see some of additional spending coming from the European nations. And then if we're able to bring in additional NATO nations, Sweden, Finland, to name two, that would also bring additional capital, manpower, and equipment in the fold and create, again, that united front. So something to continue to see. Now, how does the U.S. view what is happening? Russia should be sanctioned even if it causes inflation. 46% of all voters in the U.S. said yes. Then when you look at the breakdown, 50% were Democrat, 44% were independent and Republicans. And then when it imposed sanctions on Russia, only if it does not cause the price of goods in my country to rise, 30% said yes. So again, people are still for sanctions, even if there's some short-term pain. The question is then going to become, what happens if it becomes long-term pain, which is very likely. So that's when you start looking at few voters want to see U.S. offer direct military support. So when you look at imposing sanctions, again, the wide majority of people are in favor. Again, still below 50%, but you have to look at margin of error as there was only 1,700 people that were interviewed. But then at the same time, offering direct military support only has a 19% support ratio. That's something that when you look back at how the U.S. has interacted in every major war that we weren't involved in, this is kind of the base case. Isolationists have come back up into favor. We went from the Truman Doctrine, which was obviously when Harry S. Truman was president, at the tail end of World War II, where it was, carry the big stick type situation, walk softly, carry the big stick, but going back to Teddy, but looking at having small battles, small conflicts to avoid a bigger one. But we've gotten away from that. We've cycled out. We've been in the endless war cycles when you look at Afghanistan, Iraq, other areas in Africa as well. Again, so that the willingness is, and if you look at what happened in World War I and World War II, it was very similar, where we had that cycle back into isolationism, getting away from it. So we have to walk that line. It's just something to consider. I could do a thesis on what I think, but again, it's just wanted to create some dialogue and put that thought in your mind. So now as we progress forward, major disruptions to Russia and Ukraine grain production and exports would render a blow to the global food supply. So when you start looking at the U.S. global cereals, so looking at cereals for 2020, 16% was the U.S., 16% was Russia, Ukraine. So you're looking at these big shortfalls, which again is going to continue to create these big issues when we look at the problems in regards to food availability, how much food is available, what is cost going to do, because costs continue to rise. So as costs continue to rise, the simulated impact on economic growth and inflation. So the impact on GDP growth is expected to be anywhere from about 75 basis points to almost 1.5%. As we've said before, Europe is the biggest one at risk. We don't see that changing. The OECD is at about a percent, with the US at about 75 basis points. But the impact on inflation is going to be massive. And now it's anywhere from 1.5% to 2.5%. We think the impact on inflation is going to be higher, and that's going to put a downward move. So for us, we think inflation is up and the impact on economic growth is going to be greater, something closer to 2%, which again is going to be the bigger issue when you start looking at the backdrops. And it's all because of law of diminishing returns. All of these inherent slowdowns that we continue to see that continue to bite and really punch the consumer. And that's the biggest crux, because a lot of this is all going to be, what does the consumer do? If the consumer slows, estimates can be thrown out the window and you're going to continue to see these slowdowns. So, and this is, the new OECD forecast suggests that economic activity in the euro area will be hit harder by the Ukraine war than the other larger blocks. Inflation is forecast to be substantially higher everywhere, at least 2 percentage points. Again, all of these problems continue to move. But when you start looking at recessions typically precede or coincide with an oil shock. And it's because of what oil dictates, and it's diesel and gasoline. But diesel's the biggest piece, because diesel is, again, going to drive up the cost of every single part of that supply chain. And as we've said before, you have exponential growth when you have, on an economic level, GDP level, when you have cheap energy. So as you have these big increases in energy prices, you have a natural slowdown in just GDP growth, which is what we expect to see at this point. And when you look at the dot-com bubble, when you look at the 2008 global financial crisis, we are well above those levels, and closer to and similar to where we were in the 1990 oil price shock. So now we have price shocks at the same time where we've already had every single fiscal body ease. We've had every monetary policy go to as low as humanly possible. So we're in a very different place when you look at just how elevated we are versus historics, which is why we do believe that there is more room to the downside than really ever before when you're considering kind of where we sit on a recession side. Now, when you look at hot rolled coil, when you look at steel, HRC, spot, you're looking at something that is massive. I mean, 2021 was an outlier, and now 2022 is an outlier of the outlier. So just think about the cost that comes in. Again, steel, grains, aluminum. There is no shortfall of where the issues continue to reside. Russia's imports of alumina in 2021, a lot of it came from the Ukraine, Australia, Ireland, Kazakhstan. So when you look at total imports in 2021, 4.8 million metric tons came from the Ukraine. So now that Russia is at war with Ukraine, they're not getting alumina from them. When you look at Australia having sanctions on Russia, they're not getting alumina from them. So when you look at aluminum's going to be a shortfall. What there is no shortfall of are commodities that are going to have massive price increases, again, leading to where that recession can go, how deep can the recession be? And then when you look at the supply chain, as we learned from COVID, it takes a long time for it to fix. And we before Russia ever even went into Ukraine, we had yet to see the supply chain catch up. And we had, let's call it almost a full year of, minimal COVID risk. Yes, we had Omicron, we had spread, but when you look at hospitals and when you look at infrastructure on the healthcare side, it was minimal in terms of those impacts. And now we have these exponential problems that are continuing to rise. Now, the power surge, Contributions to annual inflation, in Europe, it's energy. In the U.S., there's a lot of energy, but there's other things, especially because the U.S. is a massive importer. So we will be exposed to those elevated levels abroad. So then when you look at wheat imports from Russia and Ukraine are very important for Turkey, Egypt, Israel, Tunisia, Thailand, Indonesia, all of these places that are already seeing other forms of inflation, which is going to create more of these underlying stretches and impact the consumer further. Which is why when you start looking at prices of gasoline at the pump per liter, you can see that Netherlands, Finland, Denmark, Germany, Sweden are all over $2 a liter. So now they're talking about tax cuts. They're talking about stimulus to protect against some of these shortfalls. So when you look at just the pricing, this is why when you look at Europe, we expect to see more demand destruction in the European theater than anywhere else. Now, when you start looking at Africa's major reliance on Russia and Ukrainian wheat, you can see that Russia accounts for $3.56 million worth of goods, and Ukraine 1.4. And when you look at Africa, they are already in dire straits prior to Russia-Ukraine issues. So again, exasperating an already bad time. And then Ukraine is a major vegetable oil exporter. Now, vegetable oil is huge for India. And I mean, obviously, of the places in the world, but India especially. So when you look at how much the Ukraine and Russia really deal, Ukraine is 25% and Russia is 11%, 23% with Russia 11%. So you're looking at 35% of vegetable oils that are either taken away from the market, shortfalls overall, becoming a huge issue in general in terms of where some of these, how can they move? What is the cost? What does that do to the local person, which increases those issues? So then when you look at fertilizer prices, the CRU fertilizer price index is at 377. This is adjusted for inflation. So hello to the highest fertilizer price ever. I should say not ever, going back to 2003. So again, you're just seeing where these prices are. And as fertilizer prices go up, so do grain prices. So, Russia, Ukraine make nice, everything goes back to normal. You still have a massive issue that is going to hit on the fertilizer side, keeping food elevated. Now, I thought this was a fun chart from Bianco Research. This goes to wheat prices, wheat per bushel going back to the 1700s to give you an idea of where wheat prices are. And this is the yearly average back to 1784. So to give you an idea of where current wheat prices are versus historics on just the absurdity of the move, given there's inflation involved. But again, I just thought it was a very interesting way to show that. Now, when you look at global negative yield, here you can see that global negative yield is at the lowest it's been since 2015, just in terms of now there's only $3.4 trillion worth of bonds that are trading negative. Now, when you start looking at, how are we going to move all this stuff around? Top ordering countries in 2021, LPG and LNG are the top areas. We continue to see some of these moves as the LNG market continues to heat up. Again, Europe is going to continue to be a bigger demand. And then, as we've been saying, from start to finish, we remain bullish on the NGL side, the liquid side, natural gas liquids, very much so. And again, that's another big piece. But it's not just them. It's when you look at yearly new builds, you can see that containers have that outsized move, as well as obviously LPG, LNG. But containers, as just we're short around the world, and now as we like to do, there's a slow reaction, which again will keep things moving forward. Now the country's importing Russian military goods, and I think this is why it's so important to consider India and China, why they have to stay neutral. In terms, not only just because they have a relationship with them and they rely so much on everything from food to energy, they also rely on military equipment. India in particular, they've been relying on Russian military equipment to counter Chinese expansion in Ladakh, in other areas on the LAC. So again, these are some important areas, but this is why we expect them to remain neutral. Now, as we see things progressing, Germany continues to eye its first build out. This is in line on the LNG front on a regasification side. This coincides with Germany signing a deal to import from Qatar. Again, you're going to continue to see some of this move and shift as we see these regasification facilities both get built out as well as increase in utilization. On the positive side, cumulative change in storage, as things have gotten a bit more mild, we can see here that 2022 so far there's been a build in European storage of natural gas. And when you start looking at LNG imports, they're at a record level, which is obviously trying to replace not only the shortfall in storage, but also replace what is being lost from Russia. So we do expect this to be the case as Europe tries to close the gap on these broad shortfalls in underlying natural gas heading into not only just summer, but also next winter. So now in the next segment, we're going to focus more on the U.S., what has happened with the Fed, and what has happened, and how has the consumer so far been impacted by inflation and continue to do so throughout the remainder of the year.